Cordova, and welcome to the Place Your Trades Network. We are the network that focuses on trading daily options using the CV Group event contracts to trade E-mini S&P, NASDAQ, Dow, Russell 2000, gold, silver, euro, crude oil, natural gas, copper, and Bitcoin. Today, I have an amazing show for you. I have got Matt from Rocket Scooter here, and we're going to talk about the bear versus the bull case for what happens now. It's going to be great. Today's broadcast is brought to you by Tradeabate, which has built that custom app that we're all using at Place Your Trades for those CME Group event contracts. And yay! Okay, so I'm going to start off by just giving you a quick overview into the market and what I think for today. So first of all, I am going to go to my screen here and show you what the Tradeabate web app looks like. This is what it looks like on your phone. You can see here we're green. We're mean and green right now for ES and NASDAQ, and the Dow is just about flat. Oil's a little bit down, and of course then the metals are down as well. And Natty, what is going on with Natty? All right, so as far as the market goes, I was looking at the daily chart, and the daily chart had a megaphone, and price action fell from that megaphone, and the measured move for that fall was 4469.25. That was in place since last week. So last week, that's where I bought ES and added a little bit when it got a little lower in case it did, one of those undercuts. And then guess what? It went higher. I took mostly profits, left some runners. And then this morning, it back tested 4469.25 again. So my feeling is that as long as it stays above 4469.25, I am bullish for the week. So it could undercut it, of course, but but that's what I think. So if I wanted to guess on today's close, I would guess that we would close higher, and we opened today. And if I wanted to know whether or not the statistics backed me up on that, all you have to do is register for the placeyourtrades.com website, and then just go into the dashboard here, and then you can see the pre-market from Chai Girl. You can see the gap stats. So for indices here, we're looking at 55.62%. That's good. Anything over 55% is good. That will close above the open, and a profit factor of 1.2. Ideally, you'd want a profit factor of 1.3 and above. Is 1.2. I'm still okay with that. But also, I will say, let me just go to my chart here so I don't say the wrong thing. Hold on just a minute. I did take some profit already this morning at 4493.75. So now I have long runners into the rest of the day, but that's where I took profit already, is 4493.75. So I got long at 4469, got out at 0.25, and then got out at 4493.75. All right. So with that said, let's bring on Matt. Hi, Matt.
Hey, Julia, how's it going?
Good, thank you. So you guys, I had never seen, I saw Anthony Crudele interview Matt, and he showed his software, and I thought, oh, that's interesting. But yesterday I took a look at Matt's software with him, and it's pretty impressive. I mean, Matt, you're an engineer by training?
Yes. Yeah,
okay.
I was a chemical engineer.
Okay, I'm a mechie.
Oh, wow. Cool.
Yeah. But so what made you go from engineering into the trading world?
Actually, my specialty was catalytic engineering. So I did a reaction subspecialty of chemical. And so when I worked at Dow Chemical in my young 20s, I used to actually run reactor units.
Okay.
And so we used to have to repack our catalysts every 5 to 10 years, and catalysts have heavy metals in them. So I was always watching metals markets to try to forecast when optimal times to buy metals, right, for the catalyst work. It'd be millions of dollars of decision making. So I got obsessed with staring at commodities charts at a young age, trying to forecast and dig my way through to learn how to do it. And then after that recession in 2008, I kind of just leaned towards trading as I got out of engineering, and then I stuck with it.
That is so cool. And And then, you were looking in particular about, I mean, what your software in particular brings in options data, right?
Mm-hmm.
So
Correct.
it's like it collates all of the options data and then gives levels and potential price paths based on those, but based on that options activity. Is that right?
Yeah, correct. So if you think about it, like, being an engineer as you are as well, data is so important. Repeatable data is important. Looking through a data set, throwing out things that don't correlate, and keeping like what's consistent.
Yeah.
And when we get started, all of us get started trading, when there's so many things to look at, and nothing really just had this consistency where my brain would wrap around it and go, oh yeah, that will work all the time. Everything I read out of books just seemed like very weak and flimsy and no real substance or basis, very basic math of the market. And so, over the years, trying to explore and find consistent things, like Rocket Scooter's principle is that engineering foundation where you need data that's repeatable, and it has to impress me as being repeatable enough to where I'm ready to publish it. And so we do, the idea was, what is repeatable in the market? And computational trading, market maker hedging, delta and gamma hedging, these things are consistent and everybody does. So the idea was, could we pinpoint and find areas of the market where there would be unusual volume or pressure, and predict where it will be based on the way options draw that risk landscape? And the answer is obviously yes. And we created the foundation of what's inside of the Rocket Scooter platform. And it derives all of its information from options. Options are, to me, when you're looking at technical analysis, you're taking past price data and trying to forecast pivots in the future. And it seems to be that yesterday's action doesn't really predict tomorrow's activity. But if you buy a SPY 450 call for this Friday, you've announced to the world that you were long 100 shares of SPY at 450 in the future on Friday. So it's like future looking that incorporates time and price and desire. And if dealers are on the other side of your trade, then you'll know the risk that they have to take as those options, the options going in and out of the money. And then you can just do some, basic math. Doesn't understand options, so basic math, but options math to really understand, where invisible pressures are in the market from that acquiring of positions. And options just spell out that future landscape. It's the only future predicting thing that I think there is, because it's people showing you their cards and their intention at some point in the future.
Well, that's awesome. I don't say this lightly, I was really impressed with the software. And I don't know if it was because of the software or because it agreed with what I think. I was like,
that's always else, right?
Oh, I don't know. I mean, I think it's I should.
So if I agree with what you think all the time, then we'll be better friends, right?
Yeah.
That's
Okay.
cool.
Yeah. Exactly. No. I don't mind people disagreeing at all. Like, I can be somewhat of a contrarian for sure. But
Yeah.
what I try to do is buy support and sell resistance.
Mhm.
And some people think that's risky.
Is that? Yeah.
I don't know. So anyway, so as far as the market overall, we've gone up this year a lot more than most people would have thought. We did take a dip in March, and now we're at a place where we've gone way up. We've come down a little bit. So the question is this a healthy pullback right now that people will be buying and then we're going to go higher? Or are we going to go lower from here? And so I wanted to get I know what I think, but I wanted to get your opinion, and we can talk about it a little bit, and then see what goes from there. Okay.
On the surface, I was probably one of the biggest bulls on the planet back in last October when market dipped. The very 2 days after we dipped, I made a tweet and said, this is the bottom and we're rallying till the summer. Rocket Scooter forecasts risk pivots and the markets using one of our technologies called monthly maps. And it just showed that the market was sustainably bullish from October. When everyone in the world was bearish, it flipped and turned into a bottom. And the major mechanism that caused that had a lot to do with this AI hype and the tech squeeze. In all honesty, if you think about it, back in the 1980s, we didn't have, internet and tech boom, everything, banks and oil, these were the top stocks in the S&P. And then now, since the 2000s, tech is it. And in the first tech boom that we had before the crash, I think the S&P went from like 400 to 1600, something like that, like, 400%. On just companies that had zero sales, zero earnings, right? Companies didn't sell anything. We're trading infinity times over earnings is the way I always think about it. And yet people didn't want to miss out on that tech boom. Now, no, people didn't believe that the internet would be the future as much as they do now. And the utility wasn't there because we didn't have high-speed modems and constant connectivity. But those fund managers then are still working now 20 years later. And they're like, oh man, I missed out on that last tech boom. And they laughed at me all the time because I didn't believe in it. I don't want to miss out on this one. And so the AI thing is a realizable future. AI is a thing now. It's not, flying us to the moon yet, but I mean, AI is writing movie scripts to the point that the writers are striking. AI is, editing all my photos to actually make me look better. Like it's part of life. It has utility now. So people just don't want to miss out on that, despite there not being, a lot of good fundamentals in the background of the market. People don't want to miss out. And the fundamental reason why markets go up a lot of the time is that people don't want to miss out, or people that are short betting against it get squeezed by people don't want to miss out. So we rallied on this tech boom, and I think that kind of lifted the market out of the gutter for a little bit. And the Fed was forecasting, tapering rate hikes. In all honesty, that's a pretty good sign of stability. And the Fed's narrative is they don't want to see the market crash, create a recession, or create a period of stagflation where they would have to come in and initiate QE again to pull us out of. And the Fed very strictly wants a policy of QT. And so to have quantitative tightening, they have to drive a very narrow ship to keep the market from collapsing on itself, or else people will become unemployed again. And we're in this very high inflation, high unemployment situation that becomes like your soup kitchen Great Depression and not just a gentle pullback. So the Fed, I think, won't let the market crash by producing or doing things or driving the narrative to maintain bullishness. So that and the tech bubble kept us going up. Now in the background, there's obviously a very, very strong case for bear market. And obviously, I think that my short-term outlook is that we may have seen the top for the year a couple of weeks ago, and that credit rating downgrade really brought forth the realization of the problems in the bond market, the inversion of the 10-year, 2-year curve. Obviously, something you want to take note of that usually precedes periods of high volatility and possible like pullbacks and sell-offs. And a lot of this move, down we've seen the last week it's pullback. And I would say that it's healthy for now, since Rocket Scooter shows we're probably healthy in expiration. But I think we rally for a little bit. We probably peak back up close to 4,600 at the max. And then I think we're probably in for a really bad September, October. The positional data disintegrated for the first time all year when that credit rating downgrade came out. The very next week, we just saw those strong bullish positions that we're literally holding till October vanish, and they end in about a week from now. So the market just looks like it's ready to pull back, but not violently pull back, but like slowly start trending down over the course of the fall.
I think that's a hard market to trade in when things are, things have been just pretty much straight up. And then if it starts chopping down, we've been conditioned, so to speak, to buy the dip. So it's, and you do have to take profits and shorts and then re-short if that's what your plan is. But you're saying basically, what you're seeing from your software is that is that pops from here on out, pops should be probably sold. So, instead of that buy the dip as you and I have been doing all year.
Yeah.
You're saying that the software suggests that pops should be sold.
Well, the software is suggesting a period of not a lot of bulls still waiting to buy at these levels. I think what the mentality behind the positions show that after this Friday expiration, there really is no bull floor anymore. There's no large bull zones of calls in the money where people are looking to acquire. What I think this doesn't, and what I think this means, I don't think that it's because people are extremely bearish to the market. I still think it's going to maintain a period of bullishness, over the course of time. I don't think the market's going to crash in this kind of pullback. But what it does hint is that bulls are expecting the market to go lower before they're willing to enter in. And I think that we're probably going to see the market try to slowly trade down. It's a really weird thing to see the market trading back when volatility is in complete decay as well. This is a premium destroying environment for both puts and calls. It's a gentle float down instead of a market collapse down. So I'm still buying the dip, but my trades are short lived. I'm in and out within an hour. If I short a high, it comes down to it, I'm going to get in and get out for an hour. I'm not betting on big swinging volatile market collapses, right? The market just is too stable right now to do that. And there's a reason for that in a positional data. I can show my screen really quick.
Yeah, let's do that.
This is a cool little thing. Let me pop up the commitment traders now. Again, this is something that I talk a lot about. It's a little controversial because it's futures and people don't believe that it mirrors the risk of the equities market. But I prove a case all the time that the risk in the futures market, this is the S&P E-mini, will very much match the risk built into the equities markets. As like ETNs and ETFs, people hedge those by using futures. So their long positions match their long exposure. Asset managers is like the long only side of the market, and they have been accumulating a genuine net long since October's bottom. This total reportable position to the CFTC has been growing like week over week. And they're just starting to sell a little bit, and that's why we've been pulling back. And so the other thing is that since the bottom of the market, there's been a growing short. This blue line is that leveraged hedge funds, and they've been growing a net short position and just shorting and getting squeezed, shorting and getting squeezed, shorting and getting squeezed. And so as people have been trying to short this, the tech boom and the rate hike tapering has been kind of squeezing shorts higher. And so what you're actually seeing is that every time the market dips, there are shorts that have been short for a year waiting to cover and get out. They've been upside down since last year. It's not people shorting now that are creating anything. It's people shorting back then that every time the market dips, they're finally getting out. And you're starting to see like those pops every time the market does dip. Shorts are covering, shorts are covering. So the mechanic from here is likely to be a possible short squeeze from here to continue the market higher if it does go higher. But clearly you can see that the long side of the market is kind of starting to flatten out and taper. Now, with short squeezes, that can propagate a market forward. And I'll show what happened after COVID. The same thing happened. This was really strong for the bull case. Is that like after COVID crashed, you saw a big net short wrapping up that over the course of year and a half plus, those shorts were squeezed despite asset managers selling. Like in the middle of 21, Fed was announcing QT and rate hikes. So everybody knows, okay, market's bearish from here. And the asset managers have been dumping their position, but yet we rallied for 6 more months because old shorts are being unwound. And so the really strong part of the bull case is this old shorts could be unwound to keep propagating the market forward despite bad news and bad fundamentals. And we're just seeing a gentle, healthy pullback. If this was something that was catastrophic to the market, we would see a growing change in the VIX. The VIX would be starting to build in that expected volatility. Yet the VIX has been in decay since 5-6 days ago, and we haven't sustainably created that market panic because every single time the market dips, there's some shorts that cover. Anytime the market rallies, there's some longs that sell. So it's like this force pushing against the market, kind of keeping it in stasis. It's a really neat situation.
There are so many bears that have missed this rally this year, and they've missed the rally in their favorite stocks. And I see every single day when I look on Twitter, people are like, oh, I hope it goes down so I can buy my favorite stock at whatever level, because they didn't. So it's like, it almost is like the bulls want it to go down, the bears want it to go down.
Well,
so
bears want it to go down, but there's actually a lot more bears that want it to go up. They want it to go down so they can cover. Yeah.
Yeah. So but sometimes that sustains us upwards because it never will get to that level they want to buy again. Like every time it gets close, it'll go back again, and then that's what makes it so hard. I find that choppy downward activity, I find it really hard to trade. I like COVID type situation. It's easier, right? You get short, you stay short, and then you get long, you stay long, right? I mean, it's choppy, but it's still
choppy and not volatile. It's like you're getting little 10-point swings here and there. Yeah. And it's a weird environment because, all the bears come out of hibernation on the first 2 or 3 red days. So like, I told you so, but when you look, it's like the S&P's down 50 points. And this is the start of the collapse, right?
Then it's also like, well, when did you tell me so? If you told me bearish, 3 months ago, and now you're calling like on the first little 1% correction, you're calling like, see, I'm like, no.
Remember that meme? There was a meme where everybody's like, it's over celebrating last place person. I don't know if you saw it. It's like a meme where people are standing on the stage or at the end of like a track and field event with medals, and like this guy's like celebrating. He's like popping champagne, and then the camera zooms out, and he's like in last place.
Hey, you know what? There's always something to celebrate.
Yeah.
But yeah, no, but I'm somebody who it's like I don't claim victory for something if I'm right after being wrong. That's still not right because you're wrong. You know what I mean?
Timing's everything, right? I mean, being early is still wrong. My favorite sayings I always tell people is that it's better to be 1 week late to a bear party than 6 months early.
That's true. I was early for COVID, and you know, I was a little bit early for this drop that we got at the beginning of the prior year, but not really, not early enough. But yeah, no, it can the problem is the market can grind up on you, and it just gets worse and worse. And but even for shorting here, because of the if we do have volatility, it's just going to eat up that options stuff, right? It's not 100%. Like you could, it's not like you could just know initially. So let's look at your software here.
Oh yeah, absolutely. I brought something up pretty cool. This is a picture of what the market looked like when it was strong and bullish. This is one of our features called monthly maps, which projects into the future market strength and pivots. Like this is back in June when the market was sitting here and people were very bearish. I still said the market was sustainably bullish. And the way that you just look at it is you can look at the slope of these two lines that you're on there. If they're both pointing down, it's a combination of short squeeze and buying. So the market still showed sustainable rallying and sustainable short squeezing. We teach classes on how to read this, but projecting to the future until October. Nice and clean. This top side is all bullish positioning and calls that are in the money. This bottom side is all puts, and these are all out of the money. So the bull side is really strong from June. And then the market had this really nice division. It was just bullish, bullish, bullish. And I was very strong bullish in June. And of course, going through July and August was correct. But now you see what monthly maps look like before and after. And these colors are a little different. But the bull side's at the top. Ever since that credit rating downgrade came out, we
got Fitch slapped.
Fitch slapped, yeah.
Fitch slapped.
Ugh.
I've been wanting to say that. All right, sorry.
That should have been the title of the show. I should be honest.
Fitch slapped.
So this was the one. Every single day, there's been 3 things I look at from RocketSkewer that show me the market's sustainably bullish. And finally, when that event happened, a couple of days later, I was talking to my group and I said, this is probably the top. We saw that full disintegration. On this particular chart, the red side was the same as the gray side on here. So what's nice and clean and bullish support going deeper, that bullish support just disintegrated. It's like someone threw a rock through a glass window and it's just gone. After expiration on Friday monthlies right here, the bull side support leaves. So like this shows to me that we're still supporting and rallying in expiration. But after that, there is nothing. It's not bullish or bearish. We don't have any bear zone to overlap or bull zone overlap. We're kind of floating in this no man's land. So non-volatile, flat, choppy market, and I think is what we're going to see September, October, until something changes. And every day we print out these results for anything that has options. So any index or ETF or stock or anything will show where that pivoting is. And so as we saw, that little nice clean bull zone is gone because of that Fitch slap. That particular event was what let people realize the dangers of the bond market. We have high interest rates right now. There are people calling for a credit event. Like the bear side's really strong. I mean, our interest rates for mortgages like over 7% now. I mean, some people's mortgages are up 30, 40% just on interest rates alone. And they bought them in those high premiums during COVID. And we're in this disinflationary period where people are making less salary. Is that a future event where people can't afford their mortgages anymore? And as we learned in 2008, there's 3-4 years that it builds up and creates a collapse scenario. So I don't think we're pressuring the market for things to die out today because unemployment's not that big of a deal. People are actually going back to work faster and they're getting fired. So, but credit's going to slow down ultimately, right? So you can tell that the problems with the bond market are realizing people betting on a future worse recession as the 10-year and 2-year yield has inverted lower than it has been in like 50 years. I think it's at that point where market's starting to bet on that longer term bear case, but I don't think it's going to realize immediately as far as a market crash, because as I've learned in my years of trading, market crashes typically start from a bubble being inflated and then popping, and then dominoes fall as companies file bankruptcies. Right now, we're not having a lot of bankruptcies, major Fortune 500s. And also, we don't really have a bubble. People are so used to seeing like this rally in tech and saying that's a bubble. But remember, the last tech rally bubbled 400% relative to the S&P bottom. Who didn't want to miss out on the first tech run? So 400 to 1500 from the crash in the 84 crash all the way, or like the 84 bear market all the way to 2000. For 16 years, the market went up 400% because of tech and other things. So people are really like not wanting to miss out on that. I don't think a retracement to highs is considered a bubble when a lot of this is fueled by short squeezing. It's not like people are buying absurd things without utility. People are buying into AI with immediate utility, right? So I think so we're far away from a bubble popping. So I think any recession or downside is going to be gentle, slowly drifting down, slightly choppy down. I don't see a crash scenario at all because the Fed doesn't want that to happen. So
okay, so what you're saying is we can basically kind of, like a slinky going down the stairs.
Yeah.
Like, but there. I'm trying to think of, we got a bearish event, right? We got Fitch slapped, but what could be a I don't want to speculate too much, but what if the Ukraine war ends or something like that? Would that be that could potentially be a bullish event, right? That could.
I think it depends. I'm not sure how that directly affects the equities markets. Like again, like direct U.S. involvement in wars can create, stimulation in certain markets. Here, we in the 2000s era, right, when we come out of that last recession, the market was nice and clean and rallied for many years, and we did participate in many wars. Like, I think our participation in Ukraine is very minimal as far as stimulating like growth inside of sectors here in the United States. I'm one of the people that doesn't believe it has much of a draw or effect on the market in general. I think it's one of those things that might have a lot more to commodities like oil prices and things.
Yeah,
be a little more sensitive to that. Yeah.
I was just trying to think of something bullish that could happen, not that.
Yeah.
Just to get it, and I don't know, but yeah, I don't know. I just look at lines. So what do we got going on? That's true. I always keep that stuff in the back of my mind,
Easy.
like COVID. I mean, when I heard about COVID, I'm like, that seems bearish, but the market kept going up, for a while. Anyway. Let's look at what's going on right here. So this is today, right? This is SPY today.
Yeah.
Okay.
So we have a couple of cool tools in Rocket Scooter. Everything here is based on options and arbitrage. So all of our tools, we're not using price action or any traditional technicals. What we actually do is we're looking at the options in the S&P, and you can see today. The SPY itself has migrated to a bull zone. Bull zone is where there's this definitive split in market maker options is what we're actually deriving. And so trading in a bull zone just means that calls now got pushed in the money. It's going to force dealers to start longing this to delta hedges as the delta on all options in the zone starts going higher. It stimulates further growth. So bull zone is bullish, bear zone is bearish from the idea that it creates hedging. We call it hedging pressure from the particular options going in the money. And so like this blue line and this yellow line, this is your monthly gamma maximum of dealer risk. And this is your weekly gamma maximum on dealer risk for weekly options. Hedge pressure creates like this effect where markets push away from it. And when you break through it, it's creating a squeeze where it's pushing the markets higher just on hedging alone. And so we hedged into bull zone, and now we're safely trading into a territory where like our tools called a liquidity map is showing me that the general pressure above this blue line is actually generally bullish, pushing higher. And so what we do is we map out like this constant hum underneath the like random buying and selling of you and me. The algorithms and computational trading that's revolving around like balancing. Market makers are banks that trade in the middle of all of us. They get paid to do that, but they constantly are balancing their risk to zero. And under that assumption, you can map out their risk with the liquidity map, and then you can just see, okay, they need the long or sell here to balance to zero. And that's kind of what we're exploiting, is that constant hum underneath the market of just algorithms buying and selling to match those risk changes of where price is moving through this landscape.
I have a question. Okay. So it looks like we opened below the blue line.
Right.
and then we came up into we kind of, we're like consolidating on it. I don't know what we're consolidating on it. And then we came up into the bull zone. And then according to that little map in the bottom left, the bottom right, sorry. It looks like, that it's saying if it doesn't go straight up, which it might go straight up, it could be a trend day. It's possible. So if it's not a trend day, it's suggesting that if it comes down to the blue line would be an area to get in.
Yeah. And I actually took that long today on my stream, and I actually traded through this. There's a couple of other tools that we use for direction. I'll just kind of give you a quick 1-minute spiel of all the different ones. Anytime every morning at 9:30, we map this out, and this stays here every day, and it's a new map every day. This monthly options, anytime you're trading above this yellow line right here, you're receiving long gamma pressure on the monthly expiration. So these are ones that expire this Friday, the 18th of August. So in general, what we call bull or bear structure, anytime you're trading above here, it's still bullish structure. So I get really bearish, and I like shorting markets when we're below this yellow line, because being below that yellow line actually is very bad for the markets. I have a little, let's see if I have a cheat sheet here. Oh, I don't have it with me. Anyways, below this yellow line, the markets get that negative gamma on a monthly basis, which is like where institutions are holding positions for long periods. So in general, we've got bullish hedging structure on monthly. We broke above weekly options, and now we have weekly hedging structure, which shows positive on a weekly basis. So like this week is getting that push today as well. So bullish market or bearish market, well, above monthly hedge, certainly bullish for the month in that particular sense. We have an indicator up here, this ratio. This ratio is between 0 and 1, and it's the percent of market cap of the stocks in the S&P that are in a bull zone versus bear zone. 92% of the market cap is still in a bull zone of each of the stocks in the S&P. So while the market's been gently trading down, this is telling us that the market is still bullish right now based on the stocks. 92%. When this is below 50, then I start to think, okay, stocks are bearish, the S&P is going to come down. If the stocks are bullish and the S&P is bearish, then there's a cheat that we trade the S&P to the bull zone, because the S&P by nature tracks the stocks inside of it, and the stocks inside of it are bullish, then the bear S&P is likely to connect with it as well. So this arbitrage exploit is another reason to say markets are in the short term bullish still. So bullish.
Okay, so it's almost like breadth in a way, right? Because it's almost like the underlying stocks are bullish, even if the indices isn't. It probably means that some of the underlying stocks are going to take the indices with it.
Yeah, and they're trapped. Like the thing is that even though like the majority of the stocks are trading down, they're still trapped in a bull zone where they're still falling in support territory, and the stocks are just not collapsing because they're so stuck in their own bull zones that, exactly like a breadth. It's showing overall, weighed by market cap, that the S&P is undervalued relative to the stock. So at any point when this ratio is greater than half, I'm only looking for bull setups. That's like a rule of mine. So I'm just buying dips still, and I still will until this goes less than 50. Then I'm full-fledged bear.
Got you. Okay, so you mean okay. So if after this week we start to correct, what you're saying is you might short the pops, but you're going to buy short the pops, but you're going to buy the drops still, because you believe that the volatility will be enough where you can just continue making money on both. Even if the S&P is already topped, the drops and the pops will be enough to sustain you trading in like, basically we can't just get like, I am bearish period, or I am bullish period. What you're saying
right. I tend to have three pillars of being bearish. This ratio less than half, that really tells me the S&P is going to sustainably trade lower to catch up to stocks that are bearish. That's one of them. The S&P itself trading below its monthly hedge pressure, the S&P getting its own pressure from its own hedging, also I'm bearish. So trading down here with this ratio less than half, that's when I'm really bearish on a flip of the market. So the fact that we're actually, both of these things are still bullish positionally, it means people still have an appetite to not collapse the market. And also with VIX being in permanent decay right now, I guess just like that, VIX traded up for like a couple of weeks, and VIX has just been slowly decaying. There is no volatility. So I'm not scared to buy dips because these little dips are very short lived because there is not a lot of volatility present. So it's very clean cut, at least for now. It's not going to be like big rallies, but the market's just not set up to crash just yet. And what we're going to wait for, so the three pillars I use, like I said, this ratio being above or below this yellow line. And then of course the overall monthly map, which looks into the future of, wait, where did I put that? Of how far out I think the pivot lasts. I've got bull support on these options that expire on each one of these days up until Friday already. So the monthly map bullish, the ratio bullish, being above here, gamma positive. 3 bullish signs for my sentiment to be bullish. And I'm just using the tool to find intraday pivots to long and short off of. And I'll tell you something cool. This ratio has only been less than half since the bottom in October, only 2 days over the last year. So this is a telltale sign of the market not being bearish. And until that ratio comes down, I'm still staying bullish until the positions change, despite I'm not blind to the bear side. I know the problems that are looming. I just know that nothing outweighs the power of bull stupidity is another of my favorite quotes. People will buy and you can say from the rooftops, you're dumb. You don't know what you're doing. The market's in a recession. This is going to crash. This is going to crash. And bulls will say, I don't care. I don't want to miss out of the rally. And that propagates the market forward despite bad news. So like you get a lot of heat being a bull in a bear market, right? Because people think.
I know. People called me a dippy. I was buying the dip and they were calling me a dippy, and I'm sensitive, so I was upset. But then you know what? I'm sensitive, but then when I look at my account and I'm like kicking their butts, I'm like, well, I guess they're calling me a dippy. I'm a rich dippy, you know what I'm saying? Like what?
Get it?
I don't know.
It's like when you're the most right trader in the world is when everyone disagrees with you and everyone will hate you because you disagree with them. Mm-hmm. Then when you're actually proven right, you can't go say I told you so, because then people hate you because they didn't win and you won. There's no scenario where traders march you out of the stadium on their shoulders, chanting your name and celebrating you. You're hated.
Well, unless they followed you, and then but then you don't want that responsibility in case you're wrong.
Yeah. You're hated if you're hated if you're right. If you're wrong, they make fun of you. If you're right, they don't like you. There's never a scenario when everyone universally loves you for your call. It's usually like the proportion is the more people that hate you, the better off you are.
And I can understand how that happens, because sometimes like I'm feeling a certain way and I'll look at somebody I respect and they're like exactly the opposite, and I'm like, oh yeah, like. It doesn't make me dislike them personally, but it doesn't make me warm and fuzzy. It makes me like, even this morning I was looking and different people had different ideas of how the day will play out than I did. Mm-hmm. And I was, I just try to just remember why I think what I think, mm-hmm. acknowledge what they think, and think to myself what my odds are of being correct.
Yeah,
so
that's the best you can do.
Yeah.
And the odds are pretty good. I mean, like we talk about bull case and bear case today. Positionally, the market is still somewhat bullish with a very heavy wound up short position that keeps squeezing every time the market dips down. As you see, the volatility and decay just shows there are bears jumping in now, but there are bears from a year ago who can't afford to be bearish anymore. And so they're jumping out, keeping the market floating. Positionally, markets are I always trade positionally, right? I keep the fundamentals in the back of my head. I know what's good and fundamentally know what's bad. There's actually some good fundamentals, despite there being bad ones. I could briefly touch on those, but I don't like, when you're a bull, people just think you're naive to the bear side, but like I'm always thinking of the bear side. I know I look for bullish fundamentals to start becoming less bullish, and then I just look for the positions to shift. The idea with Rocket Scooter really was to exploit where people are positioned. It doesn't matter why they're positioned there because they want to be positioned there. If somebody wants the long and it's pure stupidity, it doesn't matter. The market's going to go up. I need to see where people are willing to throw money. And that was what was important to finding consistency, because I'm not waking up every day trying to time a bear market 4 months early, betting that, okay, it's eventually going to crash. I don't say that. I mean, I have pinpoint precision as to when I think the markets are going to pivot. And something pretty cool, I always do this little humble brag, but I have this, like, let's see if I saw the picture somewhere. I use my monthly map tool to pivot a high at the top. This is the S&P over the years. I pivoted a high and said, this is a correction. I pivoted a low for 2 months. I pivoted a low for the year. And now I'm pivoting a high again. I'm finding like those right points in time to really pivot the market. These are the tweets with all the timestamps, but like right now is where I'm saying this is probably the top for a little bit, but it's not going to likely collapse. And again, I'm just using people's positions to reveal that to me. I don't need to guess. Wall Street, they call it the efficient market hypothesis, is that all information available or even unavailable, all information is effectively priced in at some point.
Can I ask something? Because I have an opinion on this, and I don't know what yours is, but we're talking about the fact that the market might kind of, okay, you're talking about this is potentially a high that we're in. Even, we've already hit the high potentially, and this week might get a pop so that people could buy puts if they choose to. So I guess the question is, do you have any, and I know it's hard because of the Fitch slapping messed up that monthly thing, but do you have any particular target where people, because I've heard so many people say 4,200, do you have a particular target of where people who missed this rally could potentially buy if it is to go back up?
Let me give you a good rule of thumb. There's a technique that we teach, which looks at margin requirements. I'm going to give you a magic number. For right now at this point in time, think 31 points in the S&P. On an average non-volatile day, the S&P will not move more than 31 points without a catalyst. So think about the market moving down and then retracing half, then moving down. So that becomes
wait. You mean 31 points from top to bottom, or you mean
from like futures close until futures close? For like generically speaking.
Okay, you're talking about the whole size of the candle, including the wicks.
No, just open to close for the most part. So there's a stability in the market right now at 31 points. We published this number. It's called a risk interval, and what it does is it shows where markets break down. So in like non-volatile clean markets, they don't break down. So typically markets from high to low. So you're right, wick to wick. Typically they'll stay like. Let me start over. From futures close to futures open to close in that range, 31 points up or down is the maximum you expect per day, give or take.
From 6 p.m. Eastern to 5 p.m. the next day. So 23 hours, because futures are open 23 hours a day, so 5 days a week. Okay. Or what?
The assumption is markets stay stable, then you don't tend to break down that 31 point range from the futures close without a catalyst. So let's pretend that there's no catalyst between now and whenever, and the market trades down exactly the maximum that you expect before it falls apart, 31 points a day. And then the next day it retraces half and then trades down again, retraces half, trades down again. They give like that kind of move. And then that becomes 15-ish points, 15 and a half points a day. So if you're trying to pick a target of how far it goes, on average, I always guess that if the market just sustainably has a slow drift down with no volatility, like we have, VIX is in decay, then you're going to lose about 15 points a day, give or take, on average. And that's basically, if you want to pick a target, if you're selling off for a 5-day period, that becomes a 75-point drop. If you're selling off for 2 weeks, assume 150, et cetera. So however long you think it's going to fall for, that's just a rule of thumb. If there's just straight red days, that's the maximum. Now, in general, if you count the candles on a daily candle chart, this is actually my favorite techniques to do. It's a really cool trick. If you pick SPX daily mode, right, you count how many red candles and green candles from top to bottom. So in the last recession, or the last breakdown from last year, from top to bottom on this huge pullback, and if you actually count the green candles, there was more green candles than red candles, even in the correction that we had over the last year and a half. So in most bear markets, there's actually a 50-50 split. There's one green candle to almost every red candle. It's really interesting. And in bull markets, it's more like a 3-to-2 ratio most of the time, like 60-40. So the neat thing is, if you gotta do this exercise right now, go to the December 21 highs and the October 22 lows and count red candles the daily and green candles in the day. There's more green candles than red. So even in a bear market, it doesn't just fall red day, red day, red day. It's red day, green day, red day, green day, almost in all cases. So now let's take that 15 points every 2 days, right? And so if you think about it, market's going to move roughly 45, 50 points a week. So if you're targeting a 1 month drop, that's how we're going to get our 200 points. It's not volatile. So if you think it's going to 4,200, it's going to take months, not weeks to get there. There's no volatility to sustain that market. That 31 points is an anchor of actually the presence of volatility, and the lack of it means we don't break that structure very often. So
Okay,
mathematics, engineering stuff,
I just want to interrupt for a quick second. If anybody has any questions, if you could reply to my tweet on X, my X on X, my X. What do you call the tweets now? X's. If you what do you call a singular tweet? A singular.
What is it called now? Are we boomers if we
still
call it
Exit? Anyway, if you could please reply. I'm just going to be a boomer and say tweet. If you could please reply to my tweet and with your questions for us, that would be phenomenal. And that way I can make sure that I get it, because I know that some people might have questions and I won't see them. So
it's hard to not say tweet. I love the word tweeting. I know Elon's going to hate me.
I know. I'm resistant to change. Okay, let's see. All right, make sure I got everything. So you're saying that even if we go downwards, it's going to be choppy downwards. So
I mean, I think so. And like, in all honesty, there's a couple of really neat things to kind of bring up in general. Like the market's actually reflecting some general bullish stats in the fundamentals world. I mean, I know a lot of bears like to ignore the things that are looking bullish, and vice versa. People tend to not look at both sides, but I tend to look at both sides very clearly. And we all know that the bear case, this is the 10-year constant maturity minus 2 years. So obviously that yield curve is negative, like the inversion happened, and it hasn't been that way since the 80s. Now, granted, this created some bearish waves in the market before the biggest rally of that generation happened, because I think I had a picture of that somewhere, actually, the S&P. I have it here. The S&P back in the 80s, I mean, it really was kind of bearish during that period of inversion, but it wasn't crashing out. There was this really interesting phenomenon. If I could pull on the charts really quick, that time period was right here. This was that actual time period where we had that yield curve inversion, 82, 84, that was in here. And while the market did slowly drift down over some time, our bear market is going to be very much like this bear market. It's not really bad or crashing. It's just slightly, you see how it's just trading lower, not really going up. It's not collapsing on itself either. I really think our market's going to mirror very similar conditions. And then once we clear through the storm, I mean, it's gonna clear us out to a really strong rally, I feel, once it's all over. So I mean, here's another wave of gentle pulling back for a couple years. And I mean, it was what was the difference from 170 to 150? The market, I mean, that's 20 points on 170, right? That's not really a lot.
Right.
12%, right? It's not a huge deal.
So if you look at the weekly ES chart, though, it's potentially forming an inverse head and shoulders. Mm-hmm. We might have already formed that shoulder over there. And potentially we've already made, if we have topped out already, potentially we've already made the other armpit of weekly ES.
Oh, absolutely.
So I guess the question is, though, do you have any idea of where, if we do chop downwards, do you have any ideas so far? And I know this could change, but do you have any ideas so far of where people could look to try and, if it is an inverse head and shoulder, where the tip of the shoulder would be on the second round here?
Yeah. And again, this is just my opinion, and I'm just some random dude from the internet, so take it with a grain of salt, everybody listening. I really do feel that monthly expiration is going to, first of all, that 4,500 is been a really strong peg over the last couple of weeks. So I don't think puts are going to get rewarded as volatility is in decay. So what I do think is we get maybe 1, 2, maybe 3 days rally. I honestly think that we make an attempt to go up here, and then it starts to pull back. I think that we do attempt maybe to fill gaps or even try to double top. I really do think that the pressure this week will be strong enough to sustain a move up. And I think that it's going to squeeze really rapidly. And I don't know how high it's going to go. We'll have to watch it on a day-to-day basis. Yeah. But I don't perceive us rallying through highs right now until the monthly maps on Rocket Scooters start to agree with that positional data showing bull support underneath. I just feel like it's a time thing. After Friday, If we wake up Monday and there's no floor underneath it, then I'm really willing and ready to short once we hit like these bear pivots and rocket scooters. So like I know that in general we're not volatile, and this is the same thing that happened back here. Market's going to try to trade lower, but it's not going to crash. I think that people buying puts all year are going to have a hard time timing these highs to short from, because without volatility, you're going to have this like just low premium environment where market's not going to crash fast enough until your option whittles away. And it's very similar to how the 80s traded. And I really feel like we're in that same environment. On a bull case, like I think people should watch, it's very important. The two pillars of bull markets is that quarter over quarter GDP growth being positive. Is you don't have that in a recession. We're currently, I don't consider it a recession if your GDP is growing, not a recession. Now in early 2022, it was that rate was shrinking, it was negative. So GDP is growing, which is great. And first time initial jobless claims, this is what I'm showing right here. These are waves of people getting fired, essentially layoffs. And since 2022, we had like 4 really prominent waves of layoffs. And while people are still kind of getting laid off now, the continual jobless claims actually showing them going back to work. This is a cool chart that helps me see that despite those waves of initial layoffs, these are total people filing for unemployment. And while it has been growing in April of this year, it's actually been in decline. So people are actually getting their jobs back, which means hiring spree. You only have a hiring spree if companies' outlook for 3 to 6 months is doom and gloom and the price of the stock's going to crash. You don't hire people with the intent on firing them 2 or 3 months later. So we're in a hiring spree with positive GDP growth. Those are really strong, slightly bull mechanics to actual market. There's actually productivity coming out of these companies. And while they're trading really high over earnings, stock market's pricing in the future. They're pricing in a better version of where we are now. The Fed not aggressively raising rates any further. That's another key sign that the volatility is just not there. The companies perceive themselves as being stable. Fed is trying to keep the market stable. And so with the yield curve inverted, in this environment, I just think that we're in this period of slow drift down. It's going to be very hard to short this market. Even if it corrects another 10 or 15%, there's not going to be like red candle crash days like there were in 2022. It's going to be down.
So you're saying we're not going to get those limit down days. I was joking around. When we were getting those limit down days, I was like, okay, bathroom break, because because there would be like a pause, and then you get to, mess around with the dogs, whatever you do on a little pause. So yeah, that does make it difficult. That's what I'm saying. It is harder to trade actually, because especially too, if you want to buy those, 3X levered ETFs that are bearish, it's very, the chop will just take away all the advantage to that. So it is difficult to just trade unless you're just short with no leverage and you're patient. Oh yeah. A lot of us are not patient.
And if you want to compare like good time, like these are just VIX futures. This is the VIX continuous contracts. So the front month curve, so the front month contracts taped on top of each other. And like you could see back in, was it 2023? Actually, let me go back to see if we have some COVID era. The volatility is just not there to show that the market's, let's go to a blank chart with nothing on it. Okay, cool. Let me just delete some of these things. All right, there we go. All right, so like back in COVID, right, when you're getting those limit down days and the craziness, I mean, VIX futures were trading at like 50, 60, 70, 80. And then even during, the first waves of cycles, I mean, you need volatility for markets to collapse on themselves. And then for years, right, I mean, for months, you just had 30, 32, VIX futures were pricing in really high VIX. And we're just not seeing that right now. I mean, this is like the one thing that keeps me from thinking the market's going to crash. Nobody in Wall Street's betting on a crash.
Matt,
go for it.
The news came out that there was like aliens and whatnot, and nobody cared. We are so jaded right now. Like we are like, and I thought it was just me, but it turns out it's everybody else too. They're like, they found aliens, or I'm not saying there was, by the way, but I'm just saying, like, generally speaking, you might expect a reaction to that, and it didn't.
Right?
I don't know that it even trended on Twitter.
No,
I think the fact that it didn't trend on Twitter trended on Twitter. That's what trended. It's like nobody's talking
so
about it.
non-controversial right now. Yeah, you can imagine like a family sitting around the breakfast table, like the grandpa reading the newspaper, and he's like, "Huh, we found aliens." And then across, the table, his wife is like, "There, oh, that's nice, dear." Like, like nobody cares.
Nobody cares. But something could happen. China could invade Taiwan, something like that. That would spike volatility, right?
That could be that's been looming since for a very long time.
I don't know that'll happen.
In 2015, there was a scare when China was starting to stockpile oil in their strategic reserves. People were starting to estimate in 2015. This is after the oil collapse. That was going to be the reason for China stockpiling. They're motivated to invade, and it didn't happen then. So I think that would create volatility. Just right now, it's kind of like this, right? The market just has no volatility. VIX futures trading at 15. I mean, we have been sustainably trading lower with the contango scenario in VIX, which is exactly what you see. The short trade on VIX is typically what accompanies a bull market. And you're just not seeing that realize. Even the attempt of trying to be volatile, it just shows you the power of shorts who have been short, ready to get out of their shorts faster than people are ready to sell the S&P. And every dip, there's shorts that are covering, and every high, there's longs that are getting out, which old shorts are covering. There's not enough pressure to offset that float up, and that lack of volatility is just proving that.
Okay, just real quick before we go, I want to get your take on oil, if that's possible.
Yeah.
Because I don't know in general, but I'm feeling like it's close to where I want to start fading it a little bit, maybe just this week, but let's see.
So you've seen the monthly maps, and this is for oil prices. Now, I think right now, utilities, energy, and financials are looking really strong, while tech is not looking as strong over the last couple of weeks. Honestly, you still see some bull side support underneath oil. The oil is not decaying. This little bull zone is still staying deeper. I think for the next month, oil is going to sustainably stay higher. I don't think there's any volatility. Now, there is a stronger growing bear position, but it's way out of the money. This is on the USO, so this is how I'm mapping out oil. In all honesty, I think that whatever happens with oil, I think it stays the course. I don't think it crashes out until this bull side starts to disintegrate like we saw. But this is still a floor under oil. For whatever reason.
I realize it has a floor. I'm kind of looking for it to a little bit.
A little bit would be like 70 on USO. I think a healthy retracement would be this kind of 70 area. Now, whatever that corresponds in oil futures. I think that like collapsing or like weeks of trending down, I don't think that's really possible just yet. But maybe a month out. Yeah. So
it was such a strong move up out of that. It had consolidated for I don't know how many weeks in this pennant on the weekly. And then when it finally broke out of that pennant on the weekly, it's just green week after green week. I think 5 in a row, maybe more. I'm not sure, but it's been a while that it's been green every week. And so I'm thinking that potentially it might get that pullback. And then it's like, well, then do you buy or does it go lower? But it could be a buying opportunity, actually. We'll have to see.
In periods of inflation and periods of recession, you tend to see certain commodities hold a lot of value. I think people, like we remember the last rally where we got some pretty good oil moves in the last pullback a couple years ago. Oil went way up, wasn't above $100 for a little bit, right? And I think that, in that kind of hoarding scenario, people tend to hoard tangible things like commodity assets in periods of equities decline, because there's going to be, if there's shortages, or there's going to be like lack of demand or lack of supply, people tend to enter a period of hoarding commodities. And you see that in energy a lot. You see that in gold and metals a lot. And those are just telltale signs of people putting their money in something tangible. Because clearly if stocks crash, a stock is just a share of a company. A company doesn't mean anything if the company's dead. But gold is something you can always hold in your hand, and somebody will always buy it from you. It's like a safe trade. And I think that the fact that the stock market isn't as strong strengthens the case that oil would be less weak and probably slightly stronger. To see everything collapsing at the same time would accompany a market crash and collapse. And without the volatility, there's nobody betting on a collapse. Either it's going to blindside all of us and nobody sees it coming, or it's just going to be stable. And I think if equities pull back, I think oil, energy, some of these things are going to stay where they are before they fall back. I think if equities gain strength, and I think those might reset a little bit. Money's going to flux from one to the other. I don't know. That's just my thought.
Oh, Matt, I really enjoyed talking with you today. I learned a lot, and I have a trial of your software, so I'm going to be looking at it every day. I'm going to be using it in combination with my levels and see whether or not I can get some kind of edge there. I'm excited. Thank you so much. I appreciate it.
Appreciate it. Yeah, thanks for me on.
All right, everybody, have a great trading week. I am at Cordova Trades on Twitter. Matt is at Traders Paradise. Is that right?
Yes.
At Traders Paradise on Twitter. And please follow also at Place Your Trades. All right, thank you, everybody. Take care. Have a great trading week. Bye.
Bye.